Okay, let's unpack this. Because if you looked at your portfolio on Friday afternoon, you probably felt that specific sinking feeling in your stomach.
Oh, yeah.
You know the one I'm talking about. We are talking about Friday, January 30th, 2026. A day that is, I mean, it's almost certainly going to get a scary nickname in the history books.
It was a bloodbath. There's really no polite way to put it. It was a historic dislocation.
Historic is one word for it. Brutal is another. We saw somewhere between $3 and $6 trillion
Trillion with a T.
in global market value just evaporate.
Oh,
In a
yeah.
single session. Poof. Gone.
And the really weird part, the part that has everyone kind of freaking out,
Yeah.
it wasn't the risky, speculative tech stocks leading the way down. It was the stuff that is supposed to be safe.
Exactly. That's the anomaly here. Usually when the sky is falling, investors run to the shelter, right? They buy gold, they buy treasuries.
On Friday, the shelter itself collapsed.
Silver dropped nearly 40% in a matter of hours. Gold lost over 10%. And Bitcoin, well, Bitcoin decided to join the party and shed about 20%.
And all of this chaos, this absolute financial violence, was triggered by one name.
Kevin Warsh.
President Trump's nominee for the next Federal Reserve chair.
Right. So we have a massive job today. This deep dive is going to be a little different. We need to connect some dots that might seem, miles apart. We need to unpack why a single nomination caused a $6 trillion flush. And we have to get into the mechanics of this, specifically something called the balance sheet trilemma.
Which sounds terrifyingly boring, but is actually just terrifying.
It really is. It's the technical engine behind the crash. It explains why the rules of the game just changed overnight.
And then here's the twist.
We're going to pivot. Because the economic theory that is driving Warsh's nomination is the exact same force that researchers say should be giving us a 4-day work week.
It sounds like a sharp left turn, but I promise the connection is solid. It's all about the AI bridge.
It's a battle over who gets the benefits of this AI boom. Is it the Fed's balance sheet, or is it your Friday afternoon? So let's dive in.
Let's do it.
So take us back to that moment on Friday.
Yeah.
The tickers just broke. I was watching silver. I mean, it fell from roughly $120 an ounce down to $83.
Yeah.
That doesn't happen in commodities.
Yeah.
That happens in meme stocks, in crypto scams. It does not happen to a precious metal that's been money for 5,000 years.
It was the worst single-day decline for silver since 1980. And the analysts, they're calling it a margin trap. The violence of the move, and that word appeared in almost every research note I read, was purely mechanical.
Okay, break that down for us. What actually happens in a margin trap?
So zoom out a bit. Silver had been on a tear.
Yeah.
It was up over 40% just in the first month of 2026. Everyone was piling in. And when you're that confident, what do? You borrow money to buy more. You leverage it.
You're buying on margin.
Exactly. So the market is long and it's leveraged. Then the news of Warsh's nomination hits. The price ticks down just a little bit, maybe 2 or 3%.
Right.
But because everyone is leveraged, that small drop eats into their collateral. And suddenly, the broker's algorithm just wakes up. It sees the account value dropping, and it issues a margin call.
Which is basically the broker saying, put up more cash right now or we take your stuff.
Correct. But here is the trap. The drop was so fast that people couldn't deposit cash fast enough. So the brokers don't ask nicely, they just sell. They liquidate the silver to cover the loan.
And that selling drives the price down further.
Which triggers the next round of margin calls for the next group of investors. It's a cascading liquidation. It's a feedback loop.
A death spiral.
And the exchanges actually raised margin requirements to 15% right in the middle of the panic, which effectively forced even more selling.
It's like throwing an anchor to a drowning man.
It poured gasoline on the fire. And it wasn't just silver. Gold wiped out $4.1 trillion in value. I mean, think about that number. That is the entire GDP of Germany just gone in an afternoon.
And then there's crypto. Bitcoin fell from the $90,000 range to, the low 70s?
Yeah.
I want to stick on this for a second. For years, the pitch has been Bitcoin is digital gold. It's a hedge against the system. It's uncorrelated. Friday was pure chaos, and Bitcoin collapsed right alongside everything else.
Friday was a failed stress test for that theory. I mean, you could argue it failed hard. Bitcoin traded like a high beta risk asset.
And high beta just means it moves in the same direction as the stock market, but more violently.
Correct. If the S&P sneezes, Bitcoin catches the flu. It didn't act as a shield. It acted like a tech stock on steroids.
But the real question is why? Why did the mere mention of Kevin Warsh cause everyone to sell their store of value assets? Why run for the exits?
Yeah, let's talk about the man of the hour. Who is Kevin Warsh? I know he's a former Fed governor, but he hasn't been in the seat for a long time.
Right.
He served from 2006 to 2011. He was the youngest governor ever, only 35 when he started, so he was there for the 2008 crisis. But his reputation is what scared the market on Friday. He is seen as the architect of a potential regime change.
Regime change? That's heavy language. That sounds like a coup.
In monetary policy terms, this is a coup. You have to understand, for the last, 20 years, really, since 2008, we've lived in a system of ample reserves.
Okay, define that for us.
It means the Fed keeps a massive balance sheet. Right now, it's about $6.5 trillion. They buy bonds and mortgage-backed securities to make sure there is always plenty of liquid cash just sloshing around the banking system.
It's like keeping the swimming pool filled to the very brim so no one ever hits the bottom, no matter how wild the party gets.
That's a great analogy. And Warsh hates the full pool. He calls it mission creep. His whole philosophy is sound money and a smaller Fed. He believes that massive balance sheet distorts markets, it creates bubbles. He wants to drain the pool aggressively.
Okay, so this brings up another analogy I saw that really clicked for me. The liquidity sponge.
Yes, this is the key to understanding the crash.
So the Fed has been spraying water money all over the economy for years. And assets like gold, silver, and crypto are basically sponges. They soak up that excess water, they get heavy and valuable, specifically because they're holding all that extra cash that has nowhere else to go.
Precisely. When money is cheap and it's everywhere, you buy hard assets to store it.
And now comes Kevin Warsh, and he's basically walking over to the faucet to turn it off.
He's threatening to turn off the faucet, and he's grabbing the sponge to wring it out. When the market realized the next Fed chair wants to drain liquidity to make dollars scarce again, the value of holding a sponge just plummeted. If cash becomes scarce and it yields a real return, you don't need to hide your wealth in gold bars or digital coins. You want the cash itself.
So the rush to cash is what caused the crash. Everyone sold the sponge to get the water.
That's it. But there is a technical constraint here that Warsh is running headfirst into, and this is where we have to get a little nerdy, but stay with me, because this affects everyone's 401k. It's called the central bank balance sheet trilemma.
I read the Fed note on this. I've got to admit, usually when I see trilemma in a research paper, my eyes just glaze over.
Yeah.
But the way they laid this out, it actually explains the mechanics of Friday's disaster perfectly.
It's like fundamental physics for central banking. A trilemma means you have 3 desirable options, but you can mathematically only choose 2. You physically cannot have all 3 at the same time.
Okay, lay out the menu. What are the 3 options?
Option 1 is a small balance sheet. The Fed stays lean, doesn't hold trillions in assets, stays out of the way.
Okay.
Option 2 is low volatility and interest rates. Things stay calm, predictable, boring.
Love boring.
Option 3 is limited market intervention. The Fed isn't jumping in every day to fix things or repo markets.
So small balance sheet, low volatility, limited intervention. Those all sound great. Why can't we have all 3?
Because the financial world is messy. Shocks happen. Tax payments drain cash. Foreign banks need dollars. A treasury auction goes bad. If you have a small balance sheet so there isn't much excess cash in the system, and a shock hits,
and you refuse to intervene constantly because you picked option 3.
then there is no buffer. The shock has nowhere to go but straight into the price. Interest rates spike wildly. Volatility explodes. You lose option 2.
So you want a small Fed that doesn't meddle. You have to accept that interest rates are going to bounce around like a ping pong ball.
Exactly.
So looking at Warsh, which 2 is he picking?
Warsh is a purist. He wants option 1, the small balance sheet, and option 3, limited intervention. He thinks the Fed should step back and be small. He believes the market should find its own price.
Which means he is knowingly sacrificing option 2, low volatility.
Yes, and that is exactly what the market priced in on Friday. They looked at Warsh and realized, oh, this guy is willing to let things break. He's willing to let rates spike and markets crash to get his smaller Fed. We are moving from a world of artificial stability to a world of, natural volatility.
That is actually terrifying for anyone managing a portfolio. It means the idea that the Fed will always save the market if it drops is gone.
It's effectively dead under the Warsh doctrine. In a volatile world where reserves are scarce, cash flow is king. You don't want an asset that just sits there looking pretty. You want a business that generates cash to navigate the volatility.
So the game has changed from buy everything to buy quality.
That's the signal.
But wait a minute, there's a contradiction here that I can't quite wrap my head around. President Trump nominated him. Trump loves low interest rates.
Right.
He loves the stock market going up. He measures his success by the S&P 500. Why would he pick a guy who wants to drain the liquidity pool and crash asset prices?
This is where it gets really interesting. This is the AI bridge. This is how a hawk becomes a dove.
Explain that. Because Warsh resigned in 2011 specifically to protest easy money. He's a hardliner.
He is. But recently, he's been pitching this new theory. He believes we are on the verge of a productivity boom driven by artificial intelligence that changes the laws of economics.
Okay, but how does AI justify cutting interest rates? Usually, you cut rates when the economy is weak.
Think about supply and demand. Usually, if you cut rates when the economy is doing okay, you get inflation, people have cheap money, they buy stuff, prices go up because there isn't enough stuff to go around.
Right. Too much money chasing too few goods. That's inflation 101.
But Warsh argues that AI is fundamentally changing the supply side. He threw out this stat in a recent speech. A 1% increase in productivity growth can double living standards in a generation.
Wow.
He thinks AI allows companies to produce so much more stuff so much more efficiently that supply will just explode.
So even if there's more money floating around, there are plenty of goods and services to buy, so prices stay down.
Exactly. He calls it raising the economy's speed limit. He's telling Trump, I can cut rates for you, not because the economy is weak, but because the economy is getting superpowered by AI. We can grow faster without overheating.
That is a very, very convenient political argument. It solves Trump's problem perfectly.
It's an intellectual bridge. It allows Warsh to do what the president wants, cut rates, while still claiming he's adhering to sound money principles because the productivity gains are real. He's betting the house on AI.
And he might be testing this theory sooner than we think. What's all this drama with the current chair, Jerome Powell, the DOJ investigation?
It's getting messy. There is an active DOJ investigation to Powell regarding renovation spending on his private residence.
Which feels, let's say, timed.
Many in Washington view it as political maneuvering. Powell's term doesn't officially end until May 2026. This investigation puts immense pressure on him to resign early, effectively clearing the seat for Warsh to step in right now.
So Warsh is coming in hot. And he is betting the entire U.S. economy on this one idea.
Yeah.
Productivity. Yeah. Top-down, GDP-level productivity.
Correct. He thinks AI fixes the debt, fixes the deficit, and fixes growth.
Okay, so let's hold on to that word productivity. Because Warsh is looking at it from the top of the mountain. But there's another side to productivity.
A human side.
The side that affects you and me on a Tuesday morning. The side that affects how we actually spend our lives.
Right. If Warsh is right and AI is making us drastically more efficient, if we're producing so much more with so much less effort, why are we still working 40, 50, 60 hours a week?
That is the multi-trillion-dollar question. If the machine does the work, who gets the time?
We have some fascinating data on this from an economist, Juliet Schor at Boston College. She's been leading these massive pilot programs with 4-Day-Week Global.
And this isn't just a couple of hip tech startups in Silicon Valley, right?
No, this is robust data. We're talking about 245 organizations, over 8,700 employees across the globe, all kinds of industries. They switched to a 4-day week, 32 hours, with no cut in pay.
100% pay, 80% time. What happened to the output? Because the Warsh argument would imply we need to keep the pedal to the metal to get that GDP growth.
The results were staggering. Productivity actually stayed stable or rose. Revenue at these companies ticked up. They made more money.
And what about the workers?
Employee turnover practically vanished.
I mean, obviously, if you offer me a 3-day weekend every single week, I'm never leaving that job. You'd have to drag me out.
And the well-being stats were undeniable. Huge jumps in mental and physical health. Workers reported they weren't coming into Mondays feeling drained, they were recharged, burnout collapsed.
So let's apply the Warsh logic here. If AI is boosting our speed limit, like he says, and we can physically do 5 days of work in 4 days, why isn't this the standard? Why did Warsh crash the market with a nomination, but we haven't crashed the 40-hour work week?
Juliet Schor has a very specific answer for that. She says the barrier isn't data, it isn't economics, it's control.
Control.
She argues that management resists the 4-day week because giving time back to employees feels like a loss of power. Even if the output is better, the optics of an empty office on a Friday feels like slacking to a traditional boss. It's about power dynamics, not performance.
It's the butts and seats mentality. If I can't see you typing, you aren't working.
Precisely. But the pressure is mounting from some unlikely places. Did you see the clip of Bill Gates on Jimmy Fallon recently?
I did, and it shocked me. This is the guy who practically invented the modern, sleeping under the desk work ethic.
Right. And now he's predicting we might only need to work 3 days a week, maybe even 2. He's explicitly linking this to the same AI boom Warsh is banking on. He says if machines do the bulk of the drudgery, humans should be freed up.
So here is the synthesis, and this is where I want to land today.
Right.
We have two visions of the future just colliding head-on.
Go.
On one side, you have Kevin Warsh and the Fed. They see this AI productivity boom as a macroeconomic tool. They want to capture that surplus efficiency to fix the national balance sheet. They want to use the AI gains to pay down the $38 trillion debt and strengthen the dollar.
Right. They want to monetize the surplus to stabilize the financial system. They want the dividend of AI to go to the bondholders.
And on the other side, you have Bill Gates and Juliet Schor. They see the same productivity boom, but they want to use it to fix the human balance sheet, to give us time back, to fix burnout.
It's a battle over the surplus. AI creates a surplus of value. Who gets it? Does it go to the Treasury to pay for the past, or does it go to the worker in the form of a Friday off to pay for the future?
And Warsh's shock on Friday suggests that the financial system is going to fight tooth and nail to claim that surplus.
That is a very cynical but perhaps accurate way to look at it. If Warsh is right and he tightens the money supply, if he makes cash scarce, companies will be under immense pressure to be profitable. They might use AI to cut headcount, not work hours.
Right. It goes from, hey, AI helps you do your job in 4 days, to great news, the AI does the work of 5 people. We're firing 4 of you, and the last guy still works Fridays.
That is the risk. The control problem Shore talks about gets amplified when money is tight. When liquidity dries up, managers cling to control even tighter. They get scared.
So we have covered a massive amount of ground. A $6 trillion crash, a new monetary doctrine, the mechanics of margin calls, and the sociology of the work week. Let's distill this. What does this mean for the listener right now?
I think there are 2 big takeaways. First, for the investors listening, the rules have changed. The Warsh Doctrine means the era of ample reserves is ending.
The swimming pool is being drained.
Exactly. You can't just buy liquidity sponges like crypto or gold and assume the Fed will inflate their value forever. In a world of reserve scarcity, you need assets that generate real cash flow. You need to own things that make money, not just store money.
And the second takeaway, for the person just trying to plan their career.
It's about the future of work. The technology for a 4-day week is here. The economic justification, as even the hawk Kevin Warsh admits with his productivity theories, is here. But it's not going to be given to you.
Because of the control issue.
Right. If you want that AI dividend to be time off rather than just higher corporate profits, it's going to require a cultural shift. It's going to be a negotiation.
It is ironic that the same chart Kevin Warsh is looking at to set interest rates is the same chart you could show your boss to ask for Fridays off.
Productivity is up, boss. The Fed chair says so.
Try that on Monday. Let us know how it goes. Though maybe wait until the market stabilizes a bit. If your boss just lost 20% on his Bitcoin, maybe give him a day.
Yeah, definitely read the room.
I want to leave you with this thought. We often distinguish between finance and lifestyle. We treat them as separate buckets. But Friday showed us they are locked together. The Fed's decision to drain the sponge crashed your portfolio. But the reason they are confident enough to do it, AI, is the only thing that might save your weekend.
We are trading asset bubbles for potential free time. The question is that a trade the economy is willing to make?
And more importantly, is it a trade you are willing to make? Would you take a 20% hit on your Bitcoin if it guaranteed a 3-day weekend forever?
I know my answer.
I think I do too. Thanks for listening to this deep dive. We'll be watching the confirmation hearings closely, assuming they happen.
See you then.